Welcome to ABU Group Podcast. Today I have a topic that we're going to speak about that's primarily geared towards business owners and to the professionals that serve business owners, and that is of captive insurance companies or micro captives or 831B plans. There's a multitude of names, but I have with me a longtime professional associate that is a captive consultant, and his name's Ed Bryan. And I've worked with Ed for about 15 years, and we've become good friends. We talk on a regular basis regarding captives or clients that have them. And welcome, Ed. And
thanks, Adam.
Yeah, thank you. And maybe give us a little start here and tell us, what is a captive, I guess, in plain English?
Sure. No, thanks for having me. There's a lot of different versions of captives, but I think what we want to talk about and what we've talked about previously is small captive insurance companies. They're also known as reinsurance companies. You'll hear them referred to as 831Bs or micro captives. So there's a lot of different names, but it's basically a small insurance company that a business owner owns that allows them to pay premiums into it, and they enjoy the benefits of that insurance company rather than paying, say, premiums to a third party, a traditional carrier, and never getting any of those premiums back. So it's a way to self-insure with tax-efficient dollars for business owners.
Okay. Well, thank you for that, Ed.
Sure.
Why do they exist in the first place?
Yeah, so that's a really good question. So traditional insurance markets are not the most efficient. Insurance companies are very slow moving. And so over the last, let's call it 70 to 100 years, actually, there's been gaps. There are exclusions, there are exemptions in traditional insurance. And so back in the 80s, if we talk specifically about small captives, so there's a lot of history prior to this, but this is probably the most relevant. Back in the 80s, there was what we would call an insurance crisis. Traditional carriers were raising rates, they were increasing deductibles, and so business owners, specifically small to mid-sized business owners in the United States, couldn't get the insurance they needed to operate. And so Congress said, okay, we recognize that small to mid-sized businesses are the lifeblood of the U.S. economy. And so we have to give them the incentive to self-insure or set money aside for a rainy day. And so they created the 831B tax code, right? Ronald Reagan signed this into tax law, if you will. And that's really why they started, because of the inefficiencies in the insurance market for small to mid-sized businesses.
Okay. Well, is that the problem that they're still solving and they've been solving, is the insurance gaps?
Yeah. So it's interesting when you look at, if we think about the 80s, we always like to think, well, history doesn't repeat itself, but we know that it does. And so over the last, let's go back, let's call it 2020, but even before that, but let's just talk COVID, because who doesn't love to beat that dead horse? We saw the shortfalls in the traditional insurance market. They were not equipped to handle what happened with COVID. And so and then we just look at the evolving risk landscape of cybersecurity. I was talking with a private banker, the business banker the other day. He said, we have seen an exponential increase in fraud, phishing, malware, spoofing of invoices. He said it's probably gone up 200 to 300% since COVID. And traditional markets, sure, you can get cyber coverage, but there are a lot of exemptions and exclusions. And the one thing, you and I have talked about this, the worst thing for a business owner is to think they have coverage, and then they go to file a claim. And it's like, oh, hey, by the way, on page 70 of your policy, there's no coverage. So yeah, so I would say primarily the intent was, and it still is, to address the shortfalls or cover those exemptions and exclusions in traditional policies. That's the primary use, and that's what you would see the general insurance space treat these as, kind of a wrap around traditional policies, but there are obviously other benefits.
Okay, great. And you're right about all the scams and the phishing, and I get a lot of them.
Yeah.
So yeah. So at what point does a business owner start to consider this as a possibility?
Yeah. So what we look at is, we don't necessarily look so much at the type of business, right? Because I don't think anybody that's going to listen to this is going to argue that small to mid-sized business owners have more risk, I would think, just from a financial standpoint than even big businesses, right? Big businesses a lot of times have reserves. They're using tools like these already. So we look at revenues of about $3 million plus. Now, I'm going to give you a really wide delta here. $3 million where we start to have the conversation. And the caveat or the qualifier there is that they have to have healthy margins. We've talked about this. They have to have excess cash flow. We have clients that do 700 million plus in revenue as well. So there's that massive delta. Our sweet spot is probably somewhere between 5 million and 50 million in revenue. And once again, margins matter, right? Because the one thing business owners have to consider here, you have to almost look at this as a forced savings plan. And so that's something to keep in mind. For a year, the money has to be locked up, right? It's tied up in policies. You get some benefits off of that. But the last thing you want to do is say, okay, hey, I really want this. I really want to do this, but I tie up my cash flow and then I can't run my business. So there's a balancing act there.
Yeah. Need to be able to have money you can park.
Yeah.
So what kind of risks are actually covered in these captives?
So this goes back to the first thing I said. There are a lot of different flavors of captive insurance. But in small captives, generally they're used to address the shortfalls in the traditional market. So things like political risk. Everybody up until the last couple of years said, oh, that's not a big thing here in the United States. Well, tariffs, right? Those are tied to political risk.
Sure.
The war in Ukraine, right? These types of things impact us here. So political risk is a really hot button one. Cybersecurity, we touched a little bit on that. And these cyber policies are written in a way, or most of the policies in captives are written in a way they're more broadly written. So what that means is those exemptions and exclusions on your traditional policy that no one reads because they're written by attorneys, they're designed to cover those types of things. Supply chain interruptions, really hot. Brand protection, dispute resolution. Like it or not, we live in a litigious society. If you're a business owner, a lot of times people think, hey, I'm just going to sue them. They've got millions of dollars. So dispute resolution is another big one. And then you start to look at things like warranties. All right, you look at protection plans and service contracts. So anybody in the service space, the auto industry, those are important as well. And then the dental space, some other specialized products. But it's basically what we're trying to do is ensure where your cash flow comes from or incidents that would fall outside of your traditional insurance from a business perspective to ensure that if something like that happened and there was an outlay of cash, you have the money set aside to address that.
Okay. Are there businesses that are best fit for these?
Yeah. So, you heard me say we don't necessarily look at industry, but we do.
Yeah.
Construction's a big one. We look at the medical field. We look at energy, right? We look at manufacturing, distributing, tech, a lot of the tech companies. And then we have a lot of people in the financial services space, whether it's property and casualty insurance brokers or financial advisors like yourself, or we have a lot of law firms that we utilize these as well. And, people in cryptocurrency, right? I mean, there's a lot of, we just talk about, you think about those industries we just talked about. There's so much evolving risk that traditional carriers, frankly, they can't, but they also choose not to, or they won't cover those types of things because they don't have enough data points to say, okay, I'm going to accurately price premiums in a certain way, because the one thing traditional carriers won't do is they don't want to take losses. It sounds morbid, but life carriers know for the most part how many people are going to die every year, right? Life insurance carriers,
and
planning
for it.
They are, and they've got those data points and they've dialed in those loss ratios. A lot of the things that we're covering in these small captives are things that there are just not enough data points on. We'll go back to COVID. Who could have predicted COVID? No one, right? At least on the insurance side. And so it's those types of things. I mean, we have things that you just can't even make up, right? That happen with business owners. We've all seen it where it's like, man, that came out of left field. I'll give you a quick example. I have a client sold a business, and that's the other thing. We do a lot of buy, sell, right? So when people have a liquidity event, a lot of times we'll put like tail coverages in place, but we just had someone sell a business. Received $15 million in cash. Great. This was just in January. They kind of drug their feet putting a captive in place. They knew they wanted to do it. Well, last Friday, so this is very recent, they received a demand letter from a former employee who said, hey, you owe me 20% of the business. They think it's baseless, but talk about sleepless nights. All of a sudden, they're looking at a lawsuit for $6 million, because this former employee is trying to lay claim to the business. And even if they dismiss it, they think it's baseless. How much is that going to cost in legal fees? If you set money aside, those are the types of things we cover. So it's up until that point, smooth sailing. And all of a sudden they get the demand letter on Friday and they said they didn't sleep until Monday. So,
okay. Are there businesses that are not a good fit?
Yeah, I would say businesses that have really narrow margins. That's tough, right? You talked about that. Other than that, we don't do a lot in obviously the nonprofit or the public sector because frankly, they're already receiving those benefits from that tax advantage basis. And they get access to some of those government programs that allow them to just do some of the same things that traditional business owners are going to have to do on their own. Right. And then I would say, other than that, we don't do a lot in education, although we do some stuff with people that build charter schools. But other than that, I would say I look more at revenue because once again, this goes back, I'm going to sound like a broken record here. No business owner has a shortage of risk,
Sure.
Right? Or even if they think they do, out of left field, something happens and it's like, wow, I should have had some money set aside for a rainy day.
Okay. When people are looking at these, I've noticed just because I've had a lot of these conversations, whether it's tax professionals or legal or business owners themselves, there's a lot of misperceptions, misunderstandings. What do you think is the biggest mistake that business owners make or professional when they're looking at these?
Yeah, there's a couple. That's a really good question. And I would say it's a couple of things. One, there's a very significant misconception that you have to be big or bigger. You heard me talk about those sweet spots. There are a lot of people that think, oh man, I need to run a business that does 25 or 50 million minimum to look at these. And so a lot of times in the CPA community and even the financial service community, there's that perception that you have to be big business. Captives only work for big business. And so a lot of times what happens is the business owner actually doesn't even get to look at it because their trusted advisor already made the decision not to bring it to them. So there's that piece there. And then the other thing is people will say, oh, well, a captive will trigger an audit because there obviously are some tax benefits associated with captive insurance. And so you get a lot of people saying, oh, that's a guaranteed audit. Well, if it's done right, that's not the case, not what we've seen over the last decade plus. But there's a lot of people or CPAs as well. And I love CPAs. I'm not picking on them. A lot of close friends that are CPAs, but they are dictating what they bring to their business owner clients as far as solutions with their own risk tolerance. Meaning, hey, I think this sounds risky, so I'm not going to present it to you, even though it might make a significant difference in your business. And so it's those types of things. The IRS, obviously, and then obviously the piece about, hey, you have to be really big to do this.
One of the things that I've also noticed over the years in talking about these or having these discussions is there's more complexity with these, and I think sometimes that kind of can be a factor too. What do you
Absolutely.
think?
No, that's a great point. I'm smiling just because a lot of business owners that we talk to, and I would tell you all over the country, you sit down with them and you say, hey, you should look at owning an insurance company. And they look at you like you're crazy, right? Like, I wouldn't know where to start. Their CPA doesn't know where to start. And so, yes, there is the perception that these are very labor intensive. They're hands-on. They're very complicated. And so that stops a lot of people from seriously considering them as well.
Okay. Well, next, cost. What does it cost to set one up?
Yeah. So in general, to set one up with there are different administrators or managers, insurance managers out there. I would say if you're looking for somebody that's going to bring you a good value, it's going to cost you roughly $6,000 to set one up. Now, a decade ago, 15 years ago, that might have been $25,000. So the cost has come down, but I would tell you it's also stabilized a little bit. Meaning, I think we hit a low spot about 4 or 5 years ago, and we've come up just slightly, maybe not on fixed costs, but on some of the variable costs. And I would say so the range is probably between 5 and 10,000 to set one up. 6,000 is kind of a good number. And then from there, based on premiums, right, there's a percentage that gets retained out of there as well.
Sure. And is there ongoing costs?
Yeah. So to set one up, like we talked about, it's, let's call it 5 to 10,000. Let's just use 6 as a number. Yes, you're going to pay that same management fee every year, right? And really what that's doing is that's renewing it with the insurance domicile. That is also going to cover the tax return. And admittedly, a lot of that annual carrying cost is tied up in the tax return. The tax return is not something that most CPAs do, or frankly, they don't have the option in their tax return software to do. And so these are specialized returns and they have to be done accordingly. And so the cost has gone up on those. That's really what's driven that fixed cost.
Okay. Thank you.
Yeah.
So from a business owner perspective, how should they look at the economics of these? And I know there's a lot of different kinds of captives, but
Sure.
maybe in the most simple terms.
Yeah. So I think I would look at it as this. You have the opportunity to self-insure with some tax-deferred dollars for risks that fall outside of traditional insurance. Meaning, am I saving money in my business for a rainy day? And most good business owners are. The problem is the way the tax code is written, there's no incentive to keep that money in the business or it's going to be taxed. So your dollars don't go as far, if that rainy day comes. Well, here, if we set up a captive insurance company, we can expense those dollars off as insurance premiums. We get to write those dollars off at the operating company level. They go into an insurance company, and now I have basically my whole dollar to address risks that are unforeseen. So that's really the way to look at it. And I would say even the simplest terms, think of it as a tax-deferred savings account. Okay. Right? I mean, if anybody that's listening is familiar with HSAs, think of it almost like an HSA for a business.
Okay. And how long does it normally take to set one up?
That's a loaded question, Adam, because we've set them up within 7 to 10 days.
Mm-hmm.
I would say on average, it's probably about 3 to 4 weeks to get one set up. So about a month.
Okay. And does it take a certain amount of time, like in years, for it to make sense financially?
I will say yes and no. I'm going to tell you the no first. No, if someone sells a business and they have a liquidity event and they're trying to ensure that buy-sell agreement or the risks that are associated with that, mm-hmm. right? Because a lot of business owners, they think, hey, I don't have to worry anymore. Well, you've got these risks that are out there. And so they'll defer costs. And so we'll one-time fund, right? We might set it up, pay premiums 1 year. But those policies might take 2 to 3 to 4 years to earn out. Right. Other than that, so take that scenario out. So that's kind of the 1 year. Mm-hmm. I tell most business owners if this is something you want to look at doing for at least 3 years, 3 to 5, then it usually is something we can consider. What we don't want to do is take the business owner who had their best year ever and barely makes it into the program, and they fund it one time, and then they never fund it again. Couple things. One, the client's not going to win because those annual fees are going to eat away at the tax benefit. And number two, they're not going to be happy with any of us because they're stuck with something that they used once and is not really suited to what they're trying to accomplish or what they're able to accomplish financially. So 3 years is a minimum. I like 5 though when I'm talking to people. Is if this is something we want to keep for 5 years, then let's have the conversation.
Okay. Like maybe go through like the top few benefits of a properly structured captive.
Sure. Well, we talked about this at the beginning. It is a very efficient risk mitigation tool, right? There are so many risks in business that traditional insurance won't cover. It's to cover that, hey, I'm laying in bed at night as a business owner. What if this happens or what if that happens, right? So that's the first and foremost is risk mitigation on an alternative risk financing vehicle. You get access to an enterprise level tool or strategy, albeit on a smaller scale, but it can be just as impactful. And then obviously there are some secondary benefits. We still consider them significant. You won't hear us talk a lot about them. We frame it in the context of there are significant tax benefits, right? So when you pay those premiums, just like your traditional policies or your premiums, you write those dollars off. You heard me allude to that earlier. You write those dollars off, but the difference is now they go into a tax efficient vehicle that you own. And then there are some benefits down the road to that. So increased risk mitigation and some pretty significant tax benefits as well.
And I would imagine that a lot of people would be drawn to those two things, right?
Absolutely. And here's what I would say. A lot of times people will come to us for the tax benefit. And that's the other thing in the industry. A lot of times people will promote almost exclusively the tax benefit. It's significant. We don't shy away from it. However, I've been doing this long enough to know that the risk mitigation piece or the efficient addressing of risks that fall outside of your traditional property and casualty policies really matters.
Sure. Can you give an example of how that's worked out beautifully for a business owner?
Yeah. So I'll give you one that's really recent, actually. I had a client who formed a captive last year, said, hey, I don't think I'm ever going to use the policies, right? They liked the tax benefit. They wanted the tax benefit. The CPA said, hey, you should talk to these guys, help you set it up. Well, in January, they were impacted by some winter storms in the northeast part of the country, and they were shut down for a while, and they found themselves filing claims within 60 days of forming their insurance company. Never thought they would have to have it or make claims, but there they were. And we could tell those stories over and over again. I had a client, she was in a major city on the East Coast during COVID. She was a doctor, but she was deemed non-essential. And she had, set up an insurance company the year before. I'm never, ever going to use it. I still remember, I'm never going to file a claim. I want to put the money in and then down the road, access those dollars. She called me in a panic. Would have been February of 2020, the end of February. And she said, hey, I tried to file an insurance claim with my traditional carrier for business interruption. And she said they wouldn't even let me file one. And the conversation went like this. The insurance carrier, the claims department said, hey, have you had a fire or a flood or an earthquake? Anything physical that stopped people or patients from getting to your locations? She said, no, I was shut down because of COVID. Well, they argued that's not physical. That's not a business interruption coverage reference to random exclusion, right, for a named pandemic in her policy, and she couldn't file a claim. And then she was able to file a claim for a contingent or a third-party business interruption claim with her captive, and she was able to infuse cash back into her business. Now, this is before the PPP program. It was before the ERC, and for her, it was a lifeline or a bridge to get to those programs. And so it just made her more resilient. I think she realized the value there.
Okay. Well, Ed, I know you've been in this space for at least 15 years, and maybe there's some evolving trends. How does the IRS view captives?
This is a very timely conversation, Adam. Within the last week and a half, there was a pretty significant win in the small insurance company space, right? The 831B space. Last year, the IRS put some new regulations in place and kind of strengthened some existing ones. But there was some punitive language or some assumptions on the IRS's part that all small insurance companies were bad. And so they were making it more difficult to do. Still doable, but it was becoming more and more complex. A couple of weeks ago, a judge in Texas, in Houston, in the federal court down there, a district court, struck down basically the most punitive part of those regulations. Now, it remains to be seen how widely accepted those are, if the IRS is going to appeal, but we feel very confident that this is a really, I would say, I'll call it a turning point to where we think the IRS is going to say, okay, this is what right looks like. This is what doesn't look right. As long as you stay over here, there's some safety. And so we feel comfortable with that. People ask us, like, are you guys still forming small captive insurance companies? Absolutely. We're going to do it right. We're going to treat it like an insurance company. It's not a put the money in on Friday, take it out on Monday to buy a boat, right? It's a real insurance company. But as long as we fall within those guidelines and we're seeing these positive signs from the IRS, we feel pretty comfortable with some safety there with the IRS.
Great. So some of the language that I've seen over time that sometimes people get spooked by is the IRS has called them potentially abusive. Can you speak to how these potentially do get abused?
Absolutely. No shortage of examples there, unfortunately. And that's a key word, abusive, right? Well, the IRS talks about their definition of abusive is basically what I just said. Money goes in on a Friday, comes out on a Monday to go buy a boat, or, they loan it out. They don't have performing loans. Policies never get issued. And then if we wanted to really get into the nitty gritty, you'd start to say, okay, were the policies something that applied to your business, right? Was there an element of risk sharing where we're kind of really digging deep now to say, okay, were we really an insurance company? How are surplus dollars treated? And unfortunately, there are groups out there who take the approach that, well, because the IRS hasn't issued a safe harbor ruling in 10 plus years, that must mean I can do what I want. And so it gives the industry a black eye. That's why we don't think that the IRS scrutiny is a bad thing. And in fact, we'd like more clear direction because there are groups out there that are abusing it. And so that's the challenge, right? Is you hear abusive and everyone thinks, a lot of people will think, well, they're all bad, but that's not the case. And abusive, it's pretty easy to see.
Besides those examples of abusive, Ed, are there other red flags that the IRS is looking at or people should be aware of with captives?
Yeah, I would say, well, a couple things. One, and this is maybe a little bit of maybe not recent news, but it's important to note. The PATH Act did away with the ability to have lineal descendants. So your children, business owners' children own the insurance company unless they own a pro rata or proportional share of the operating company. So what was happening is estate tax planning attorneys were getting a hold of this tax code, and they were having the minor children or grandchildren of business owners own this so they could get outside the estate tax. And a lot of times these children, grandchildren, et cetera, didn't even know they owned insurance companies. And so the lineal descendant piece is important, right? We have those conversations all the time. And then loans are still somewhat of a gray area, right? And so you have to have performing notes. Loans are not necessarily an issue, but they've got to be papered. They've got to be documented. There has to be a promissory note. The other thing there is that you can't take the money out, say it's a loan, and never make a payment. If you
at least have to make the interest payments.
Interest payments, yeah, absolutely. That's the thing. It's got to look like what an insurance company would do.
Okay, great. And all the other one that I've heard about in the industry is as business owners trying to put too much money.
Absolutely.
In these.
Yeah, and that's another piece, right? Is that the IRS says act like an insurance company. Okay, well, what does that mean, right? So some groups will rely on actuaries. The IRS just says you can use actuaries or you can use an established methodology. And so there has to be some restraint shown there. I think I've told you, I know groups out there that are allowing people to put away half their revenue, and that
starts to look like a tax shelter at that
absolutely
point. Yeah.
Right.
Yeah.
I mean, and so that's one of the other things, right? Is there's got to be some restraint there. And then the other thing is that let's say that you've set up a captive and you've funded it for 3 or 4, maybe 5, 6 years. Well, at some point, if you've never had claims, you never take dollars out, you probably should slow down the funding, right? Because are we overfunding for the risks that we're underwriting?
Okay. A lot of considerations. Seems like more need for good consulting, good administration, and good advice around that.
Yeah, absolutely. And you've heard me say this, and I'll say it again. Captives aren't for everyone. Mm-hmm. We talk to business owners all over the country, and there are a lot of considerations when it comes into making the decision on a captive. And so, yes, it's one of those things where we can pull from, and people that we work with can pull from thousands of examples, right? And use case studies. And every year there's a handful of clients that we will be introduced to that are potentially interested, and we will be the first ones to raise our hand after having the conversation, doing some due diligence, saying, probably not a fit for you. So,
Well, so if you were to contrast, Ed, like a well-structured captive and maybe an aggressive one, that like, what are some key differences between those?
yeah, so I would say that you need to have clearly documented policies. You need to have a clearly defined underwriting procedure or process. We need to have policies that apply. So this would be for a well-run captive. We need to have clear direction and guidelines on how the balance of those premiums are treated while they are backing up policies, what you can invest in, what you can't, what you can do with the dollars down the road. And documentation is another big piece, right? Everything needs to be documented, whether it's a change in ownership or a distribution or a change of policies. And so that's a big piece as well. And aggressive, really what you're looking for is someone that's kind of going to tell you, hey, well, we can do whatever we want, right? Or you can tell us what you want. I mean, I could tell you horror stories. I've heard people say, I set up an insurance company with this group and then they told me to Google, what I want to cover.
Huh.
Right. Or you can write your own policies. Right. So
There'd be obviously no risk sharing or.
Right. Yeah, exactly.
Yeah.
No risk sharing, never any claims, policies that don't apply, or policies that have poison pills, and what I mean there is they write a policy, but in one of the clauses in that policy, it basically exempts or invalidates the entire policy.
Huh.
That happens. Right. And because here's the thing, nobody wants to risk share. But that's how insurance works. That's how insurance carriers work, whether it's auto or, general liability or E&O. There's an element of risk sharing in the back room. There's a risk co-op. Insurance carriers just run that in the back room with all of our traditional policies. Mm-hmm. If we don't have risk sharing, which is a big piece, right, then that's a red flag.
So as far as the ongoing compliance requirements, I mean, how much is on the business owner or in their team versus, say, the administrator of the captive?
Sure. That's a good question. And so what I would tell business owners is you need to understand what's going on. You need to understand the transaction. You need to understand the responsibilities. And really the responsibilities for the most part are completing your underwriting application, signing your tax return. If you have a claim, filing it, right? And the lift for business owners is not exponential. Most of this, if you have a really good captive administrator or captive manager, is going to land on their shoulders, our shoulders, your shoulders, right? To make sure you should have a team of people around you. On your side, it's the money management, ensuring the funds are properly invested inside the captive and done efficiently. We're going to consult on, accessing dividends or underwriting. Maybe this is a new policy that you need to consider. But if you have a team of people behind you and then the captive manager, really the business owner can rely on that team with a very high degree of confidence.
Well, speaking of team, Ed, what are all the parties involved? Because at first it's a little overwhelming, having
Sure.
gone through that and been with business owners. Can you go over that?
Yeah, and it does sometimes feel like there's a lot of moving parts. And so let's start with the captive manager. The captive manager is kind of your administrator, the gatekeeper, right? They serve as the hub to make sure that underwriting applications are completed, the entity is formed properly, and then you have them issuing invoices, making sure policies are issued. If claims are paid, they're run through them. So they're kind of your hub. And then you have groups like captive consultants, right? Where we're going to come in initially from an education standpoint and a design standpoint and really kind of dial in, hey, this is how we think we want to use this. And then we go to the captive manager to form it. And you're part of that team as well, right? We have those initial conversations. And I'd argue those are more educational than business development or sales related. We're going to give you all the information you need to make a decision. And then from there, right, you can decide to move forward. And then once again, obviously the money management piece is critical, right? On your side with a financial advisor, I can't emphasize enough working with someone who knows how to manage money in captives. But really, that's kind of the three-pronged approach. And then sometimes, depending on how things work, we'll bring in, a captive insurance attorney. Not all the time, but we have access to them, and the insurance administrator has them on retainer as well. So
Okay, great.
Yeah.
On a different note, what are some questions a business owner should be asking in the beginning if they're kind of curious or they want to explore it?
Yeah, I think the biggest thing for business owners is just finding someone that can educate them instead of sell them. Right? So, finding someone they can ask, hey, do you think a captive might make sense for me? What are costs? Right? You want to know. Sometimes there are administrators out there that they sound like they don't charge anything, and the next thing you know, they're billing you for everything under the sun, and your costs were 2 to 3 times higher than going with someone else who gives you an all-in. I would ask for references. I would ask how long someone's been doing this. Can you provide me examples of successful use cases and real business owners that I can talk to? What are the size of your risk sharing pools, right? What are your claims like? Those types of things, examples of policies as well. So those are the types of things I would just say, start to ask. And the other thing I would say, back to the asking, I would ask every question, right? I would, because a lot of times business owners, this, they hear one thing and that's not really how something works, or they glossed over something because it was the end of the year and we waited until the last minute to do it. So I always say, ask all the questions up front. We'd rather answer the questions and have you feel comfortable to move forward than rush into this and you don't ask because you're unsure, because sometimes there's some significant consequences from a tax standpoint in jumping in before you're ready.
Got it. So if somebody is unsure, like what are some logical steps that they would take?
So once again, and once I know I sound like a broken record here, find someone who's impartial. Find someone who can look at this objectively. You, our team, right? Somebody that's in the space, maybe a CPA that's familiar with captives, and say, okay, does it make sense for me? Right. And then the other thing, probably the most important thing for me, is timing.
Yeah.
I would argue that's probably the most important one. Do we do it now, or is this hey, do we need to wait 6 months, or do we need to wait a year, or can we get this done in a timely manner so it doesn't feel like we're rushed? I would ask that is, when is it right? I always say timing is one of the most important things. At the end of the year, because of the tax benefit, people get excited. And CPAs sometimes will say, oh, hey, let's go do this. If it's rushed, no one's happy. So timing's a big thing. And then just, I would say, ask all the questions. Find people that are familiar with captives that are not trying to just sell you on a strategy, but truly want to educate you and help you make a decision that's going to be best for you.
Yeah, I've seen it, especially at year end, where somebody's like, hey, my friend has one, or maybe my CPA mentioned it, or I read about this. They know just a little bit about it. We'll talk about some of the main points, and they're like, okay, I'm ready to go. And I'm like, no, you need to spend a little more time on this. Do you think there's a certain amount of time that like a business owner should spend really evaluating this? I don't know whether it's hours, weeks, or meetings, or
and so I'll answer that in two ways. One, depending on who the trusted advisors are around that business owner, because a lot of times I've seen this with CPAs, I've seen it with financial advisors, I've seen it with you. You're prepping clients for this kind of decision throughout a year. It might be 2 years in advance, 3 years in advance. And so sometimes these business owners aren't necessarily aware that the questions and the conversations are leading to this. And they're just doing what a good advisor does, trying to find out, is this something my business owner might be interested in? Maybe financially, okay, they're in a spot where, hey, they have the excess cash, we can set it aside. So I would say if you've got really experienced people around you that know captives really well, I would say at least a couple of meetings, right, with everyone involved. But you could get something like that done in a couple of weeks.
Sure.
The concern for me at the end of the year is making a decision in a vacuum. So I would tell people, I've kind of told people, if you don't seriously consider it by November 1st, maybe even October 1st, we might be better off to table this conversation until Q1 of the next year.
Yeah. You don't want to go in speed dating on.
No, not on something like this. That's good comparison.
And another point from earlier, I mean, it sounds like I think sometimes people think of this as a tax strategy, whereas in reality, it's more risk strategy first.
Absolutely. Everyone loves tax benefits, right? I mean, that's just the way we're wired, right? And so people will gravitate towards the tax benefit, but it really is a risk mitigation tool. And I would argue it gives the business owner the ability to build that rainy day fund in the most tax efficient way possible. But really what you're trying to do is build that buffer around your business, right?
Sure.
Or wrapping a layer of protection around your business. Tax benefits, absolutely. But what we never want to get lost is this truly is risk driven. And that brings me to a good point. If the only reason someone wants to do this is for taxes, we tell people not to do it.
Yeah.
Because they won't be happy. It's not an inexpensive venture. And a lot of times people, they say, I just want the tax benefit. Well, if the IRS ever talks to you and you say, well, I never had any desire to have it be an insurance company, well, that's, you're kind of killing your argument for saying, hey, this is a risk mitigation tool.
Sure. Okay. So let's talk a little bit about the claims, if you don't mind.
Sure.
Like how does the claims process work?
Yeah. So, if you think about traditional insurance, at least let's start on the front end, right?
Mm-hmm.
Someone says, they call the captive administrator, hey, I have a claim. There's an online claims form. You've got to put your policy number in it. This is insurance, right? You're going to fill in as much information as you can about the incident. And an adjudicator is going to call you, set up a call, walk through it. They're going to request some financial documents to see, hey, was there a loss here? Right.
Substantiate the
claim.
claim,
Substantiate
right?
it. Yeah. We want that to happen. Right. And the captive manager or third party administrator largely steers that ship, and they keep all of the other parties involved somewhat at arm's length. And that's good, because in the captive insurance space, sometimes there's a perception that people can influence claims. That's not the case with the administrator we work with. We don't want to influence it. We want to allow the claims process to play out. If it's covered, great. If it's not, then so be it.
Okay. So something near and dear to my heart and a lot of other people that have captives is what happens to the unused premiums over time, the investment account,
Sure.
the money that's not used for claims.
Absolutely. And that's a good question. And if you look at traditional insurance carriers, they have surplus or underwriting profit most every year, right?
Mm-hmm.
There's a reason why insurance companies have their names all over buildings and stadiums all over the world, right? So those funds, once policies expire minus claims, those funds become underwriting profit or surplus reserves to that insurance company. Well, if you own the insurance company, you have the ability to leverage those dollars. You can invest them more aggressively. You can take dividends, right? So instead of paying ordinary income tax, this is where we can start to talk a little bit about these benefits. I can have a qualified dividend or distribution declared. And as a business owner, I'm going to pay long-term capital gains tax on those dollars versus ordinary income tax in a lot of instances. You can loan. We talked a little bit about loaning. Loaning somewhat of a gray area, right? The IRS doesn't love them. We talked about it a little bit. I won't go back and rehash that. But loaning yourself pre-tax money or loaning yourself the money to be able to go invest in the business or buy out a competitor, it's attractive. So you get to enjoy, frankly, the same benefits that traditional insurance companies have. It's just your insurance company.
Perfect. So the main ways that a business owner accesses that capital that's in the captive is claims, leaving it in there as excess reserves, or taking a dividend and possibly a loan.
Yeah, you've got it.
Okay, great. So what does a successful exit or wind down look like if they've had it for 10 years, they're going to sell the business or it's just not for them anymore? What does that
Right.
look like? Yeah.
Yeah, so we always talk about this, right? This thing's an insurance company. It has a purpose. If it's not being used as an insurance company, we need to look at exit, right? And I always say it's the 3 Ds. You've got dissolution of a business or a partnership. You have divorce, a lot of times with your business owners, or you have death in the business. It happens, right? We've been doing this long enough. We've seen all of it. And all of those lead to, okay, we have an insurance company. We don't need it anymore. Now what? The most straightforward way to dissolve one is frankly to liquidate all of the positions or journal them over to a personal, the principals. But you can have a tax consequence, right? And a lot of times insurance companies aren't worth anything when we set them up. But down the road, sometimes and many times they're worth millions and millions of dollars. There's assets there. And a lot of business owners say, hey, I just sold my business or I got a divorce or this or what. I don't really want to liquidate those or I don't want a taxable event. So we do something called a C Corp F reorg, which is a really boring insurance or CPA term that basically says we form a new entity that's not an insurance company. And if we keep the same entity type and the same ownership structure, we can move those assets into a new entity that doesn't have the high carrying cost, doesn't have the scrutiny of the IRS. I always say this. I know you've heard it from me a bunch since we've talked about this over the last couple of years. It has to have a stated business purpose. It can't be solely to avoid tax. It can be a holdco, it can be an investment vehicle, et cetera, but it gives you more flexibility. And really what it does is extends the runway on what to do with those dollars and allows talented advisors like yourself and the CPAs of the world and these people to really pull levers, these tax planning attorneys, estate attorneys, say, okay, now we have this bucket of pre-tax money, not an insurance company anymore. Now let's go to work with it.
Great. It seems like that reorganization is a common interest, especially if it's like $1 million or more that's in this captive. They don't want to trigger, paying tax on that much money. So
yeah, absolutely. And it just it buys you time to plan strategically.
Yeah.
If you do this reorganization. And and that's what I would say. If you've got, I'd say even $500,000 and up in the insurance company, I think you would at least want to consider that so that it buys you some time to decide what to do with those dollars without just recognizing all of it in 1 year as taxable income, albeit at the long-term capital gains rate. Yeah. It still could be, 20, 22%.
Sure. So one of the common befuddlements is in the very beginning when they're setting up the captive and they're like, who's going to own this? There's multiple options. Can you talk about that for a minute?
Yeah, that's, and you're right. A lot of times it's that, and then what are we going to name it? People get, they start to say, okay, wow, well, what should we call it? So the naming's a piece, but the ownership is important. You heard me talk about the lineal descendant piece in the PATH Act. So you can't have your children own it unless they're involved in the business and have ownership in the business. I would say probably 75% of our clients will set it up in their own personal names initially. And then down the road, they end up, I would say a big chunk of them will end up moving the ownership into a trust. It's got to be a living trust. It can't be an irrevocable trust. Or they'll move the ownership into like a holdco. And then there's a small percentage of our clients that will have their operating businesses own the captive. That's most common when there are multiple owners to where it's not feasible to have them all own just a tiny little piece of the captive.
Yeah, seen that.
Yep.
So what makes the insurance arrangement defensible? And I think you've sort of touched on that, but it needs to be an insurance arrangement, right?
It does. So let's talk first about underwriting. Like they've got to go through a process where whether it's completing an online form or answering a bunch of questions about their business, there has to be some underwriting that goes into this. So that's number one. Number two, this goes back to what we talked about. The policies that are written, they need to be real policies. They can't be something that you just found on the internet. And as cliche as that sounds, we've seen that, right? In the bad actor space. So we need real real policies that have real coverages. And then the other piece there is that beyond that, we need to make sure that they apply, right? So the example that I always give is if you're not in the food supply chain, you can't have a food recall policy, right? Or we're not going to have a hurricane policy in Denver or here in Las Vegas, right?
Yeah.
So they've got to apply. So those are probably the two most important things.
You've mentioned the 4-part test.
Yeah, let's talk about that. Yeah. So and that's a good piece. So we need what's called risk transfer. Mm-hmm. So if we think about in our own lives in traditional insurance, we pay premiums to a carrier. Well, what we're doing is for money, right? For that payment, for that premium we're paying, we are transferring our risk to the insurance carrier for that payment. So with an insurance administrator, we really like to work with ones, and specifically ones that will have what's called a direct writer. So they actually will have an insurance company that will be the one that issues the policy. Premiums are paid there. Nobody that owns a captive owns that fronting carrier. It's owned by that administrator. So it's no different than paying State Farm or Farmers or Safeco. So I paid my premiums. I've transferred my risk, right? And in exchange for those premiums, they issue me policies. That's a big piece right there. And then the second piece is there has to be risk distribution, right? Meaning in very few circumstances can I own 100% of my own risk, right? Big business, it's easier because they have thousands of what we will call exposure units, which is an insurance term for risk units, right? Think of vehicles are exposure units, drivers, lives, right? We have to have risk distribution. So we need to share. If we don't have enough risk distribution, which most small businesses don't, they have to share risk. So we have to distribute that risk amongst other insurance companies. And that does two things. It utilizes the law of large numbers, number one. So it diffuses everyone's risk. And then also it allows us to share in claims that are unaffiliated to ourselves. And that's important, right? And no one loves claims.
Yeah.
But it's what legitimizes a program, right?
100%.
Yeah. And then on the back end, right, we talked about you've got to be able to treat the dollars appropriately, right? And the policies have to apply. And so those are the most important things.
Okay. And another area that's near and dear to my heart is talking about like the reserves, the money that's in the captive. In the simple terms, how can that or should it be invested?
Yeah. And so the answer to that is absolutely yes. The insurance administrator or the captive manager will hold a small loss reserve, right, for claims, right? So they will hold some funds, which is important, right? The IRS wants to see that there's some dollars set aside for claims. Beyond that, the rest of those dollars absolutely should be invested. I'm not securities licensed. That's you. You're the expert there. But the thing that breaks my heart sometimes is I'll see significant amounts of dollars just sitting in non-interest bearing accounts. If you've gone to the trouble to set one up, this is kind of that last little piece that really makes it a win for the client. Meaning, we set it up. Now we've got, let's just call it a couple $100,000 or $500,000 sitting. Well, at that point, the money should be invested. We would hope, right? Money makes money. And so, yes, the dollars need to be invested fairly conservatively. They need to act like an insurance company. How does an insurance company invest? Well, they're diversified. They're market-based investments. They're not taking the money and giving it to their cousin who has, is raising money for a real estate deal that's off Wall Street. Yeah. Insurance companies don't do that, right? They're very careful with how they treat cryptocurrency as well, right? You shouldn't be putting more than probably 8 to 10% into any one stock, frankly, lower than that, right? So don't want to all take it and put it into Tesla or Apple, right? And that's where you come in. Mm-hmm. That's why I said earlier, I can't stress enough working with an advisor who has experience managing money in captives.
And I've gotten to the point where I asked the clients that I work with to sign an investment policy statement too.
Sure.
And I think it makes some clear boundaries of what we're doing and what we're striving for. Is there any other last things that you would that we didn't cover or that you would want to mention?
Yeah. So here's what I would say. Small captives allow the small to mid-sized business owner to take advantage of an institutional type of tool. I think we all can look at like Apple and Nike and Google and Verizon, and you go down the list, right? Tesla, Walmart, and say, man, why do they thrive and persist through downturns? Sure, there are ups and downs from their balance sheets, but by and large, those businesses are pretty protected from the dramatic swings of the economy. Well, it's because they're using tools like this. They're leveraging the tax efficiency and the risk mitigation strategies to buffer themselves and set aside dollars for a rainy day. So for the small to mid-sized business owner, I think you owe it to yourself to at least ask the question, is this something we should consider? Find the right people, have the conversation. And if the answer is not right now, great. Now you know about it. And if the answer is, hey, this isn't for my business, at least you've looked at it. Rather than wait 5, 10, 15 years. And one of the common refrains we hear still is, man, where was this 5 years ago? Where was this 10 years ago? We really could have used this. So I think you owe it to yourself as a thinking business owner, as someone who's working on their business, not always in the business, ask the questions.
Great. And Ed, thanks for spending the time. I'm glad you were able to be down in Las Vegas, away from Idaho for a little bit and not hunting, and take some time to talk about this. I appreciate your expertise and what you do for the clients we work on together.
Likewise, Adam. It's great. It's one of those things where it really can be a game changer for business owners, and I value our relationship, and I think it can be one of those things where you've seen it. It makes all the difference in some of these business owners' lives. It can be one of the biggest levers that changes things for them. And so I just really value working with you and your approach to things and how you manage the dollars inside the captives. That's important to us, right? I mean, we get people that will come to us and say CPA brought them. Well, they don't have an advisor. Well, you're at the very top of our list. You know that. To where we will say, hey, you owe it to yourself to talk to Adam because we think so highly of the job you do with the captive clients. And I value that. We don't take it lightly. So we appreciate you.
I appreciate it. And thanks for all you do and your professionalism. And one of the things I love is that, if there's clients that are considering captives, I bring you in and I know that they're not going to get a sales pitch, right, that they're going to get some true consultation. And I've seen you say, hey, this one doesn't make sense.
Yeah. So. Yeah. And that's the thing is I can't stress enough, find people that are impartial. Yeah. Meaning people that really want to see what's best for you. Because can you force business owners or shoehorn someone into it? Yeah, you can. But if it's not the best thing for them, then, you need somebody who can raise their hand and say, yeah, this isn't going to work.
Perfect. Well, thank you, Ed. And we'll do this again sometime.
Thanks, Adam. Appreciate you.